Hey everyone, good evening and welcome to another video by Lotus Dew. My name is Abel Matthew and I'm so happy today to actually be introducing the founder and creator of Lotus Dew. Has more than over 10 years of experience within the industry and he was also a research analyst for Franklin Templeton. Uh, I'm so happy to share this conversation with you, Mr. Abhishek Banerjee. How are things at Lotus Dew?
Hey, thanks, Abel. Glad to be part of this conversation. I'm also looking forward to interacting with all my, customers. So I always try to call people who tried requesting access. One of my favorite, favorite things about this business is that I get to talk to people who are from very different walks of life. Who are doing different things, have different skill sets. So that's very very exciting for me that to get to know a large number of people who are from very different walks of life who still find meaning in what we do as Lotus Dew. So things are going great with Lotus Dew. I just wanted to also let everybody know that we have been shortlisted by Startup India program to represent Indian startups in Dubai Expo next week. So we'll also be kind of going on the podium there and explaining ourselves in front of everybody in Dubai. So I look forward to that as well. But that said, I have a short presentation, Abel. So I think maybe in a while we can start that. But what I wanted to kind of talk more about is that some of the things that are kind of crossing my mind now: market volatility, inflation, global macro. Does that even impact small cap stocks? What about my small cases? If I've bought recently, what should I do? So these are some of the key questions which I hope to kind of delve upon in this webinar. But this is more about people who have questions, who have not had an opportunity to ask questions. I think this is a great time to actually ask all the questions that you wanted to ask, but you know couldn't find the time or didn't want to put in an email. So this is a very interactive session. I think that's what I enjoy most. So as we start to address some of those questions and address some of those queries related to what is that exactly that we do, and why is this different from everything else that we think is out there. I think that's really what I wanted to.
My God, fabulously put. First off, I just want to say a huge congrats to Lotus Dew because being associated with the Dubai Expo and being mentioned there and being on the podium. Oh my God, it's definitely an honor that has to be celebrated. So a round of applause for that. I think all of us who are watching right now would also feel the same way and would like to congratulate you. So on behalf of everyone, and I believe I can speak for the viewers as well, a wholehearted congratulations.
Thank you very much. So I think what I would like to do, Abel, is share my screen and start on with a short presentation. It's just an 8 to 9 slides, and I'll not spend more than a minute on each slide. But it some sort of a context and some to set the stage for the AMA. And what is most important is if you get a lot of questions from the viewers, and then we can address them, or we can answer some of the questions that you get from other viewers, or and if you can relay those questions to me.
Sure thing. We have already compiled a few questions, and if we have any of them coming on the live chat, we'll be taking them up as well. So yeah, let's see what you have in store for us in your presentation. Sure thing.
Uh, Without much ado, I think let me just go ahead and share the screen where I have a presentation I have prepared for everybody. So um, yeah, I think welcome everybody to this evening of live session of Ask Me Anything. My name is Abhishek Banerjee and I'm the founder of Lotus Dew. What we do at Lotus Dew is we focus on use of data science as a way to create adjacent indicators, which are typically non-balance sheet indicators, to screen stocks, not just in India but in stocks outside India. And what we aim to do in this webinar is focus purely on the products that we have on the small case platform, like the listed venture capital product, and explain what is that we are trying to do there, and then what are the features, or what should you expect when you're thinking about this product. So first off, this is what you typically see for the listed venture capital small case, which is available on the small case platform. Uh, it's a basket size of 30,000 rupees, but that does not mean that you are restricted to 30,000. It just means that if you buy a basket, that's how much you need to invest so that the weights of the stocks are accurately replicated. Um, this keeps varying. This depends on the price and composition of the uh, basket. So when we started Lotus Dew listed venture capital small case back in 2019, that time it was 5,000 rupees, and now it's 30,000 rupees. It does not mean that it's become 6 times. It just means that the composition has changed and the prices have moved up. So to replicate the weight, we still need, this is the minimum investment where the weights are accurately replicated in the model portfolio. What I also wanted to kind of dwell upon is that it's our way of giving venture capital like payoff using really micro cap, small cap companies. And the idea really comes from the philosophy of venture capital investments, where it's not only the capital but the kind of people who are backing the capital and the network and the reputation they put online to back those companies. That really means a lot for these smaller companies, and that's really what we are trying to articulate using this selection mechanism. We have generated good returns in the past, but this is all historical. So going forward, I'll explain what we think of Lotus Dew as a way of selecting these kind of stocks, and what does future hold for small caps and why we think so, right? As you can see that we have compared the typical ratios, balance sheet ratios, with what we see in the benchmark. In certain terms, it could appear to be more expensive than what the benchmark is. But in India, it's kind of a market where it's always traded high on PE. So typically in India, the fable is that people who have tried time P, they have generally found it quite difficult. So, this is not a factor-based portfolio. We are not looking like a way to select stocks as X times P versus Y times PB. We are focused on things like the Sharpe ratio, which is, the returns adjusted for the unit of risk, which is, one of the measures of understanding how a strategy back in the past has performed compared to what you could have achieved using a passive benchmark. That said, the next slide is, I'm going to convince you that why is this a product which is different than what you would typically get in a, let's say in a PMS format, or in a, mutual fund format, or in a even an AI format. So what happens is that India traditionally has been sort of a capital starved country. So there have been a lot of these small and mid-sized and micro-sized niche entrepreneurs who have found it easier to raise public money through IPO than to access bank credit, right? So, the credit appraisal process is a very onerous B2B process, whereas IPO is more of a B2C process where you find a large number of minority investors who like the business and the management behind it, and hence want to fund by being equity shareholders. What that means is that there are about 2,500 companies that are listed in India that have less than 1,000 crore, or roughly $150 million in market cap. And it's such a large number of stocks that presents many problems, right? For example, because they are not as traded in high volume and as high frequency, not all stocks can have technical indicators associated to. So technical analysis really doesn't work. In fundamentally, there's a large issue around how well the balance sheet numbers are representing the actual business. So often these factor-based strategies don't work. And fundamentally, if let's imagine that I have a team of 5 analysts, and each analyst is they're experts and they can cover 2 stocks, complete analysis in a week. Each analyst gets 500 stocks, so 250 days to actually do fundamental analysis on 500 stocks, right? So because there are 2,500 stocks, even with 500 analysts, even with 5 analysts, it's very difficult to analyze this universe. So this is where we saw an opportunity as a solution, where we thought, why can't we give a sort of a ability for a customer who doesn't probably have 1 crore to invest in an AI also benefit from the upside that microcap companies give with proper selection. And next, I'm going to talk about how important selection is and why is that a very key consideration. I'll come to that slide very soon. But first, let's look at typically in a stock, which is a share of a business, you get many kinds of returns, especially for the I'm focusing more on the listed equity. You of course have the stock return, which is the return that you get by holding the stock, holding period return. You have something called liquidity premium. So that just means that stocks that are less liquid, when you hold them and you hold the right ones, just the fact that you're holding a less liquid stock, when they tend to do well, that liquidity premium shows through. You have something called convenience yield, which is basically the fact that you go ahead and the when you own something, the convenience of owning something actually turns out to be more than somebody who is willing to buy it. It's more of a technical thing around behavioral finance, but it exists, and this is what one of the things that you could capture in a portfolio. Sector return, of course, that means that whether you're overweight or underweight a sector, dividend is the return of capital from the company saying that we have excess capital, we don't know what to do with it. Let's give it back to the shareholders. Uh, then you have the buyback from the market. So when the management feels that the stock that they are, getting priced by the public market is undervalued, they might use their retained earnings to buy back some of the shares as a way to indicate the future value of the company from the market, from a market price point of view. So these are some of the returns that you would typically see in a stock. But what I want to show you is that in this space, right, in the really micro cap and small cap space, uh, there's a huge variation of return, and that really presents the opportunity of active management. So what I have in this slide, it's a busy slide, so I'm just going to walk you through slowly. I have divided the stock universe of NSE into 5 buckets, right? I'm saying let's look at some of the 5 buckets like industrials, consumers, materials, financials, and healthcare. And what I've done is I've taken the last 12-month return of stocks that represent a subsector like bulk printing and railroads in industrial, home construction and personal products in consumer, materials and forging or metal fabrication in materials, financials. You have diversified financial services, investments, and in healthcare you have biotech and generic health services, right? So what I've done is it's a very simple thing. It's just the top performing sector versus the bottom performing sector within a large sector. And what I want to show you is this is just the last 12 months, right? So the huge variation between the best and the worst is exactly where the active opportunity is to select actively versus, let's say, being a passive investor where you would take the average of these two. So uh, in this space specifically, because the opportunity set is so wide, active management is something which works if you are investing in the right set of businesses. This is a little bit of a historical chart where I wanted to tell you more about global macro and growth and inflation, how they play a role in liquidity, interest rates, demand and supply. And eventually, we'll walk through a case study. But I want to pause in this slide and weave in the budget that we have seen and how does that impact our global macro situation. Uh, One of the key things in the budget was there's hardly any change, right? So the message, as I interpret, is that what tweaking we have done so far that has seemed to show results. So we're just going to continue with the momentum, and that is what is the language of the budget. There have been some minor pruning and adjustments around the edges, but essentially the message is carry on with what we have set out in that context, right? Couple of things have played out. So the most important thing that I look at is the announcement of digital currency. Now, what is digital currency and how is that important for small caps or equity markets in general? Physical currency would get replaced by digital currency, where it'll be most of the informal market economy that gets priced at a generally a higher inflation than actual reported inflation, which is why you find people in the informal economy suffering more when prices rise when compared to people who work in the formal economy, which is more of people like you and me who have formal economy income. This is the reason why we don't understand some of the issues that are faced by people who are purely earning from the informal economy through cash payments and small earnings through cash. So here, once the digital rupee adoption happens, there'll be general deflation, as I foresee, in terms of end inflation of wages and inflation of goods and commodities that purely impact these people who are most impacted by the inflation. And if that is the case, if that were to work out through the digital currency circulation, more of the economy will move from informal to formal. That will create more, and a strength to the rupee, which is generally deflationary by nature. So all of these ties together. Why this is important is that if you think of a equity as a value of store of future discounted cash flow, what you discount with, right? So what is your denominator, which is your interest rate? The lower the interest rate, the higher the valuation that can be supported by the same cash flow, the same earnings outlook. So if you have the earnings outlook there, and your interest rates keep falling, this gap actually inflates the assets. So that is called asset inflation, and that is how you can understand that we have traditionally seen Nifty at 25, 28p topping out, and average being 16, 17. And that was when we had interest rates of 8%, 10%, 12% even. Now the interest rates are way lower. So the propensity or the ability for lower interest rates to support higher PEs, how valuations can be justified as one of the ways of justifying higher PE valuations. And this is the impact, right? So we have to tie in the fact that budget is more focused about carry on as usual, and the fact that they are more interested as a body, as a country, to lower inflation, and lower inflation generally supports higher equity prices. That's point number one. Point number two I want to make is that uh, typically over a 10-year period, interest rates, kind of normalize, but GDP growth CAGR. So, if India is doing 6% GDP, your large cap returns in local currency or Indian rupees will also match that GDP CAGR. So let's say if India does 8%, your large cap returns in the last, next 10 years is going to be 8% too. And then it's very well reported in academia that small caps have another excess 2 to 3% returns on top of large caps. In India, small cap index is Nifty 50, which has only 50 stocks, versus there, as I explained, there are 2,500 stocks as an opportunity in the micro cap space. So, and there's a huge divergence. Hence, a good fund manager or even a mutual fund in small cap space should be able to give you a CAGR of between 13 to 14% if these mathematics add up. Hence, like the bar for somebody moving out of these traditional investments should be slightly higher. And hence, I feel that if you're really talking about, the best performing mutual fund in small cap space in any given year, if you pick the top three best performing small cap mutual fund, you will notice that their 5-year CAGR works out to be somewhere between 16 to 18%. If you pick the best PMS that is performing for that year, the CAGR works out to be between 20 to 22% on an average over 5 years. And some years might be good, some years might be bad. But they are all focused on this top 250 stocks, and there few combinations of here and there. And if you want to move beyond that, you have to look at a universe that is not tracked by these investment choices, and that's what we are focused on. We are focused on the universe that everybody else ignores, because it's manually very, very difficult to deliver on that universe. And also, if somebody manages to do it, the cost of that delivery would be so high that it might not work for retail investors who do not want to put hundreds of crores together in one place. So that said, I just want to go on to the case study. I want to give you an example of what we mean by adjacent indicators which are non-balance sheet in nature. In the listed venture capital, what we are trying to say is that we want to score the reputation of the board and what kind of management is what kind of is driving that business. So this is a classic case. It's from one of our holdings where The management has MBAs from London Business School, IIM Ahmedabad, Cornell, graduates from BITS, IIT Roorkee, Purdue. Uh, it has the chairman of the Worldwide Fund for Nature, multinational, multi-country CS lawyer. If you have this kind of a team, right, and and they work for you as a shareholder, how much are you willing to pay for that team, right? So, and that's kind of the way I look at it, and hence the ability to find this data and then screen on this data and put together a portfolio that we think works in these contexts is what is kind of the work that we do behind the scenes to bring out these companies into the fore. We also have access to excellent data sources. These are all professional data sources that are not generally available to individuals, but it's one of the holdings that we hold on a Bricklinings. I just want to show the way we are able to track these companies on a daily basis. We are able to see what news they are producing, what's the price pattern, the typical ratios, and we can keep monitoring not only in this kind of platform, but we have ability to fetch this data from APIs and process the data at scale together in computer science related software that we make in house. And finally, I just want to show you the one of the case study. Now, it's not just that we are sitting on this data, and if you go to our website lotusdew.in, there's a page called Explore, where you can actually explore some of the data that we look at. Here, what I wanted to show you is one such example where we had a company called Cosmo Films, which we sold out from the model portfolio, and essentially the main purpose was that we felt it was very expensive at that point, and then it went on to double itself for the next 6 to 8 months. So we were dead wrong about this company. It continues to do well from a price return point of view, but we look at this company and we saw that there who are the people, who are the other kind of uh, systems or institutions that the management of this company is connected with. So we can see, of course, Cosmo Films, but some of the other innovative foundations, including education institutes and so on. We can map this out, and we have this data available on our website. So yeah, of course, it's go and explore this data and see if you find something interesting. You can just put somebody's name or some company and see how this, what kind of data you can find. And if you find something really interesting, do let me know. We can, tweet that, or we can put that in social media if you found something interesting. It's a lot of data, and of course, we systematically scan through it. But if somebody finds something really interesting about some person, that would be pretty cool too. So I encourage you to explore the data. And yeah, I think with that, I will kind of look at what questions I can answer, because this is Ask Me Anything to begin with.
Thank you so much, Abhishek. That was very informative. So we have a couple of questions. We have compiled a couple of questions that have come by mail and by chat. And the first question is from Bikram Kumar, who asks, what am I supposed to do with my portfolio? I have taken my subscription last month, and till now my portfolio has lost 7,000 till now. Please suggest. And what would you suggest for, let's say, users who have entered the market in the last 6 months of market volatility?
Yeah, so the first thing is that this is the equity portfolio, and 1 month is no way to judge whether it's a loss or a gain, right? As I explained that over 10 years, the CAGR of large cap and GDP is same. If you are an equity investor, you must have a 5-year horizon or more. If you want to do less than that, then you're betting on luck, right? So anything less than 5 years and you think that you're going to make money in equity, there is an element of luck in it. You could be lucky and there's nothing wrong about it, but the problem with that approach is that you're only going to invest money you're prepared to lose, and that becomes more of a gambling bet whether it's going to work out or not. And if you invest only the money you're prepared to lose, it'll never be large part of your wealth, which means that you'll never believe in the system of creating returns through a market mechanism. Hence, you have to first, it needs conviction and faith. So you have to have faith that the market works for you to make wealth for you. And the only way to kind of do that, there are really two ways, right? So you either do not tolerate this volatility and you cannot see money go down. So you mix highly volatile asset classes like a listed venture capital small case with fixed deposit returns, and the average looks smoother. or you can give it time. So if you, just as a data point, if you take the standard deviation, which is a technical term, which is the volatility of returns of any equity over 3 year, 5 year, 7 year horizon, the 7 year number is way smaller than the 3 year. So what that means is that as time progresses, volatility looks smaller. It's a bit like saying that if you're, if you look at the last 10 years, you've been sick a few times, but you're generally alive, right? So it's a bit like that. So that said, what it means is that the longer horizon you have, the more stable things look. But if you want to look in shorter horizons, it will look volatile, and that is why it's risky. Because if you have not thought through that, you're not prepared to lose money, and you've invested for thinking that I'm going to make a quick buck. You have to depend on luck, and if you're not lucky, nobody can help you.
Got it. Understood. I hope Bikram has got his answer. But Bikram also asked, when will you rebalance your listed venture portfolio? So how often is the, listed venture capital portfolio, I mean, small case, rebalanced?
So what we do is, we look at the composition every day. So out of this 2,500 stocks, we are, giving you what we think are our best model portfolio given your risk profile. And then we are looking at stocks that are not in the portfolio that we think could be in the portfolio, and we do that on a daily basis. So we don't follow any mechanical or standard rule-based procedure to decide what the next rebalance date should be. Many other strategies might do that, but for us, it's like, are we still holding the best? And not changing the composition is equally a bet as changing something. So it's very important to still be convinced about what you hold, and that is equally an active decision as, I want to change it every month. So we could technically change the portfolio any day, and we do not have any fixed rebalance schedule.
Got it. Got it. Thank you so much. And the next question is from Yashu Seth, who asks, how is NanoCap Champs different from listed venture capital? From description, it seems a microcap focused portfolio.
Yeah, so again, like it's similar to the extent that we are still using our fundamental philosophy of investing, that we want to kind of approach the universe that is normally ignored because of many justified reasons by institutional investors and even professional investors, be it liquidity, be it ability to research that universe, be it the fact that they might not have been introduced to those companies, they don't have an active investor relations team, so they don't know about those companies. So in nanocap champs as well, we are actually focused on even riskier and even smaller companies, right? So we are really focused on companies that are less than 500 crores in market cap and possibly above 100 crores, and they are really really risky companies. But within that universe, we are doing our best to understand that who are the best players, right? Can these tiny nano companies become micro and small cap companies, and could we be part of that compounding machine that the management has created, and we just passively sit and be equity investors in that effort, and and help, and that might help with wealth creation. So that's really the idea. Philosophically, mechanically, of course, because these are really small companies, there's some additional checks that we do in terms of data consistency, liquidity profile, and ability to trade, trading history and so on. But yeah, it's definitely somewhat different from the listed venture capital, where the the stocks are a little more well known than nanocap champs, but it's still one of those probably. If you look at the stock holding of a listed venture capital, I doubt if there'll be even more than a couple of overlaps with any mutual fund or PMS. But of course, I don't know that as a matter of fact.
Understood. So thank you for answering that. The next question is by Cool Tool 2010, definitely a cool name. The question is, I understand that your company also has a portfolio with another stockbroker. Apart from small case, are these the same?
No, so we of course design products. We are designing products, designing solutions, investment solutions for different platforms and different demographics and different formats, right? So what I mean by format is every platform, they cater to a certain kind of investors, and within that cohort, we try to make solutions that we think are most appealing for that cohort. So we might work with other brokers where they are introducing their clients for a advisory. It could be a full plan session, or it could be one of the model portfolios in mutual funds. There are multiple ways we kind of bring solutions to customers, and what we do on small case is quite different from what we do in other broker platforms.
Understood. Understood. The next question is from Srihari S. I want to get associated for a longer term with Lotus Dew by availing a longer tenure. Currently, option is only for 6 months. Thanks for your wonderful support. So, right away, it's a great compliment for Lotus Dew. Is there a reason why it's only for 6 months and why not more? I believe there is a specific reason for that. So, if you could make it very clear for the audience.
The regulated entity, our regulator SEBI has made it mandatory for us to collect advisory again every 6 months. So basically, it comes from the fact that maybe it was a market practice that people would collect 3 years of advisory, and things won't work out, and they would not probably refund the money, or they would not kind of be willing to provide the service that the customer has already paid for. So the regulator, to improve market integrity, they have made it important that we go back to the customer and we re-establish our value proposition to make sure that they are still willing to pay us, and that period has been set as maximum of 6 months as a investment advisor. So the best way to kind of continue the relationship is to buy the 6 month, which is the most discounted, and then put it on auto renew, so you don't have to worry about it again. But I think the fact is that it also gives you an opportunity to evaluate us every 6 months, which is we should come through for you, and then that's really my endeavor.
Got it. Got it. Words to live by. The next question is from Prakash Singh, who says, is monthly SIP a good way to tackle the current market volatility?
So it really depends on your total wealth. What we say is that because this is a volatile product, you should be very careful how much wealth you allocate to it. But we have investors who have large investment, and investors who have the first basket. And what we have seen is there are investors who do weekly SIP. They do bi-weekly SIP. They probably do 2 SIPs a week. They keep buying that basket. Some people do the SIP system, which small case platform has provided, where I think there's a mechanism through which it works. But it's a bit like it's like, as I say, it's like a buffet. It's you make your own meal. So you go to the buffet, and then these are the options. So you can eat as much as you want, and that's how you kind of justify the price of the buffet. So what I mean is that this is a fixed price, and you can allocate as much capital as you want, provided that it's consistent with your risk profile and how you are spread out in terms of other assets and liabilities. But our effort is to focus on not giving you price surprises.
Got it. Got it. I think that's a very good way to put it. So now what we'll do is we'll also go to some of the questions that we've received by mail. Since we're a little low on time, I think we can quickly jump into the questions by mail. So the first question is, I have a question, and I wish I could ask that. So the first question is the budget actually important in the stock markets, and how important is it for small cap stocks?
So budget is is a document which explains how the government is going to earn money and how the government is going to spend money, right? So earning part is the taxation. So if there's any change in taxation, that immediately affects the consumer behavior. On the spending part is which are the sectors that they are going to allocate more towards, and hence who are the beneficiaries of that. So that's really how a budget is to be seen. Budget is for the economy. Markets are listed, so all the economic activities are not listed, and therefore what you find in India is that Indian companies are mostly exporters who are listed on an average, and therefore less so of the budget, more so of how the global macro is, how stocks in India get affected. especially in the large cap space. Small caps are like really niche companies. They're doing their own thing. They have their own set of customers. Probably are a monopoly in one of the areas, and that's kind of the kind of businesses that really we find exciting.
Amazing, amazing. The next question is from Mr. Sahil. Sahil asks, is this the right time to invest in small cap stocks? And if so, why do you think so?
So you know, timing is always difficult, but what we would say is that don't time the market, spend time in the market. So I just think that the capex cycle has just started, and for the capex cycle, there's still it's the very beginning of a capex cycle, and I cannot find the reasons why there should be large risk off in the market right.
Understood, understood. Let's move on to the next question. Next question is by Harshal. Harshal asks, small caps are inherently volatile. How do you manage this risk?
Yeah, so that's a good question. So what we tend to do is when we are looking at small cap, um, the best way to manage risk is to kind of provide for diversification, which is away from the, we can only manage the unsystematic risk. The systematic risk is still there, which means if the markets fall, the portfolio also falls, right? Because we are dependent on the direction of the market. And one of the best ways to diversify risk is to increase the number of holdings and also to manage sector exposure. So these are some of the main levers we have where we are trying to manage the portfolio, the beta of the portfolio, as it's technically called, which is the how much more volatile or less volatile the stock is compared to its benchmark. Some of these factors, are part of the portfolio construction and risk management process, not the investment selection process. So I think that's how we kind of manage the portfolio.
Thank you so much. The next question is from Aditya. What kind of data sources do you use? Can a retail investor have access to such proprietary data?
Yeah, so what we do, and when we started to work on this kind of solutions or model portfolios, we realized quickly that commercial data only caters to those top 200, 300 stocks, and there's absolutely no data in the area, or very little data in the area that we are interested in. So we have built a lot of in-house technology. We have a large technology team which works on that, and that the core of that is to structure unstructured data which is out there, which people ignore but has latent information. So we are kind of like more on the, we use a lot of technology to create our own internal data lake, and then we run our own processes and algorithms on that. So some of the data, again, as I said, is the screen that I've shared is available. You can go to lotusdew.in/explore, and there you will be able to explore some of this data that we create internally. We have made it also public so that anybody who's interested, they can even do their own research with this data.
Understood. I think that is very informative. Thank you so much. And the next question is from Dhwani. Dhwani asks, can you please tell me when you were wrong about a particular stock? If you were ever wrong about a particular stock in the past?
Can you repeat?
Yeah. So the question is from Dhwani, and Dhwani asks, can you please tell me when you were wrong about a particular stock? Maybe in the past, have you been have you been wrong about any particular stock in the past?
Yeah, sure. So I mean, again, the same screen, Cosmo Films, we exited the stock from the model portfolio for the high risk profile, and we found that the stock continued to do extremely well even after we exited. So, I think being equity investors, the risk is more the upside risk if you have time in the market, which means the risk is more that you will miss out than you lose money if you actually convince yourself that to stay long in the market. Hence, I think uh, being wrong, exiting too soon is something that we have seen.
Understood. Understood. I think this is how Lotus Dew keeps building on reputation, learning from the mistakes, and delivering excellence. The next question is from Samit, who asks, "What is the typical investor profile you would recommend your small cases to?"
Yeah, so I mean, I would say that if you're uh, if you're looking for a high risk satellite allocation, that's the profile. If if you're trying to add more risk, again, this is a high risk, high return, so it's a fast moving portfolio. When it works, it really takes off. In market drawdowns, of course, it'll fall, but it must be a satellite allocation. This cannot be your core allocation, and it works for every kind of investor age, right? So age is not a constraint. The constraint really is that based on your risk profile, how much you allocate, and if that makes sense for you. So we have customers from all age groups, right? There's not one cohort. We have customers who have invested in in various amounts. So literally it kind of works for any person. We have a very good mix of investors who are both gentlemen and ladies. So we have seen that equal adoption, or very similar adoption in different kinds of states in India. So I think that the real answer is based on risk profile, how much you're able to allocate. That's kind of given it's a satellite portfolio, so it must be a satellite allocation to your overall wealth.
Understood. The next question is from Jaya, who asks, "What role can your small case have towards portfolio diversification?"
Yeah, that's a great question, Jaya. So, what I would say is that because we think that, and at least for most of the mutual funds we know, the holdings that we have in this particular basket, they're very different than what you would get in a mutual fund exposure, or typically you would get in a PMS. Uh, so, as a allocation, right? So as a this is completely different or similar to what we see in other products. So you could diversify away from those standard names. If you think about a typical AIF in India, most of the AIF category 3, which are open-ended, which is what this format is, right? Small cases are open-ended. You can go in and go out anytime. They do FNO in the top 15 liquid names, and in AIF category 3, most of them, and therefore it's just a combination of few of these ideas. Whereas in mutual fund you have liquidity constraints, because you do not know how much money is going to come in or how much will be withdrawn. So the fund manager has to work towards providing sufficient liquidity buffer, keep cash in the portfolio. Here you're the portfolio manager, in terms of when you want to exit and enter. So you can control the liquidity, which is a kind of a DI format, as to you have the ultimate discretion as to how long and when and for what amount you want to stay invested.
Understood. The next question comes from Mahavir. Mahavir asks, "The average liquidity is low compared to large cap stocks. Can someone invest a large lump sum in this?"
So we always recommend go in pieces. The primary reason is the fact that an immediate large flow into the product from yourself could only kind of create more slippage, which is a technical term, which means that if you're trading a large volume, you'll go through the order book quite quickly, and that will create slippage or impact costs over a long period of time. It really smooths out, but because you can, and because you don't need to go all in at the same time or go all out at the same time, I would say do your transaction in pieces. It's always a better idea than to kind of do it in one go. As famous people say, market is a mechanism where money moves from impatient to patient. So the more patient you are, the more markets will reward you.
I think that's a very valuable words of wisdom, especially in this time, because yeah, we need to be patient. So thank you so much for that. The next question is from Sunita. So Sunita asks, "How much should someone invest in your small case?"
Right. So I think we kind of address this. First, you would do your risk profiling. We would collect data around what's your asset liability mix. This is a satellite allocation. If you're in the highest risk profile, uh, if you have total equity allocation of, let's say, 100 rupees, do not put more than 20 rupees for the highest risk profile. And similarly, for moderate, it goes to 10, and for low risk profile, 5, right? So be cognizant of the fact that when you're investing, this if this becomes a dominant part of your portfolio and you're not a person who can kind of take that kind of risk hit, and you're can live through it, it's just going to make you more anxious and uncomfortable with your portfolio. So that is why risk profiling is important. It's not that it doesn't work in the long term, but different people react to risk differently, and it's just to absorb that information and stay focused and have the faith. And not everybody is willing or able to do it. So that's why we always say, if you're the highest risk profile, 20% max of your total equity allocation.
Understood. Unfortunately, we are actually running out of time, so we'll be moving on to the last question now. The last question is from Mahak, who asks, what other small cases are you working on right now?
Yeah, so what is very interesting is that we always want to create products that or investment solutions that do not overlap with what other formats are doing, because that's really the value, right? You could go and buy like a mutual fund, which is a great investment. I mean, you get a lot of value for buying a mutual fund for the kind of price that they sell at, right? Which is nominal if you purchase a direct mutual fund. Those formats, again, you can also scale very quickly and scale in and out. Here it's more DIY, it's more kind of differentiated. So I would say, we are working on products which are also non-balance sheet indicator led. So we are working on new ways of discovering momentum than the non-traditional way. So traditional momentum is looking at, maybe a 1 month, 3 month, 9 month price return, and using that as an indicator to create a basket. Uh, I mean, that has the first time people discovered that was in 1991. There's a famous paper by Jagdish and Titman. So my question there is that 30 years have passed, so there is a chance of innovation there. So we're working hard on innovating on that aspect, and as soon as we have something exciting, we'll bring it forward.
Uh, to be fair, we have all the confidence in Lotus Dew to bring out innovation. Unfortunately, we have run out of time, but I really have to say, today is a weekend, and I tell this to all the guests that come in, but I believe I can't stress enough of this. Today is a weekend, and Mr. Abhishek, you have taken the time and the effort to come on a weekend to explain all this for us, and it really means a lot. Thank you so much for doing this. Would you have any last parting words?
No, I think great questions from the audience, and I always feel that the audience in on small case is way smarter than the average first time investor, because they're already accepting that there might be a way that we can purchase quality advice, which is different from the first time doing it myself and maybe learning something by losing money. So I think the questions reflect the high engagement and the curiosity that the customers have who are on the small case platform. So thanks, and it was a pleasure answering all the questions.
Thank you so much. And before we go, if you or your friends haven't properly seen the entire video, you can watch it again, share it with your friends, your family members, anybody who are interested in small cases and Lotus Dew small cases. And if you want to know more about Lotus Dew small cases, please visit the link in the description box where there is a link to listed venture capital small cases and other Lotus Dew small cases. And if you'd like to see more content such as this from Lotus Dew, please click on the subscribe button and please click on the bell icon so that you don't miss any notifications. Thank you so much and have a wonderful evening. Bye
Thank you very
bye.
much. Evening. Bye bye.